Howdy, Jacob here. Today we're looking at Paysafe in the IT services industry, 1.2 billion market cap on 3.4 billion enterprise value. They provide end-to-end payment solutions globally. Payment platforms offer a range of payment solutions comprising credit and debit card processing, digital wallet, e-cash, fantasy sports, casino, streaming video gaming, digital assets. Okay. Company is based in London, United Kingdom. All right, so revenue growth, we are seeing some. Honestly, less than what I thought it'd be, but we are seeing some. So gross margin declining from 66% to 59% over the last 5 years or so. Revenue is up roughly 6% a year or so. The earnings per share are negative though, and it looks to be, although they have an operating margin, they also have a lot of debt, which we can see through their enterprise value being well over double what their market cap is. So let's look at that first. 202 million cash on hand, 2 billion goodwill, 1.2 billion other intangible, with 2.5 billion of long-term debt. I do like that it's down from 2019 to 2023 about 20% or so. It is a good amount down, decreased. But with that said, I mean, that means they've also written off a lot of the acquisitions that they've had that they assigned and other intangibles that they assigned as goodwill and other intangible assets. And so from that perspective, I mean, definitely not as attractive. The income statement shows nothing going to R&D. That's kind of interesting. And as expected, this net interest, due to having as much debt as they have, is really destroying their operating profit. And then also their immense write-offs from acquisitions they've done in the past that haven't worked out very well. But on a free cash flow basis, which is the more important part in my eyes, has been a lot more consistent. So although negative in 2018, 2019 to 2023, the last 5 years, they've produced at least 200 million in free cash flow. And so here their capital allocation is going to debt, acquisitions, reinvestment in intangibles, and a slight amount of share repurchases. So I think that's enough to get me to make some assumptions here. The thing I'm going to remind people, this price to earnings, price to free cash flow, when your enterprise value is as different as the market cap as this is, you either need to put some margin of safety in this being like your price to earnings, price to free cash flow are based on enterprise value, or put it in your discount rate, because when you have this much debt in relation to market cap, things can get a little wonky. And so for me, on the revenue growth side, I don't know why they couldn't grow 5% a year or so. Let's do 4%, since again, I'm going to have to assume some money is being allocated towards debt reduction, because again, roughly 200 million in free cash flow, with over 2 billion in long-term debt. That's over 10 years of their free cash flow to pay off that debt. That's a huge ratio, and it doesn't even look like their free cash flow is growing immensely. So it's not like, they could triple it in a couple years and it would go down to a 3 or so, 3 years of free cash flow to pay off their debt. And so for me, I'm going to have to be assuming a good portion of that capital is being allocated to debt reduction, which is going to dampen their ability to do other forms of capital allocation, such as dividend acquisition, reinvestment, share repurchases. And so with this net income margin, I'm going to base it more off the free cash flow. So maybe let's do 14 and 16% share change. Let's just assume they offset stock-based compensation. That's going to be using roughly 20% of their free cash flow. Oh, flat. Flat is going to assume that they use roughly 20 to 40 million, whatever their stock-based compensation is, to share repurchases. and then their PE, price to free cash flow, by the end, even with a good amount of allocation going to debt reduction, I'm still probably going to be looking for a much lower PE and price to free cash flow than normal. And so, I mean, I guess, yeah, I don't feel comfortable with these margins here. Let's do a wider range. Let's do 10 and 13%. I mean, the free cash flow is also declining from 2021 to 2024, so I have to put that into consideration. I mean, I think this is fairly close based on the numbers without doing any additional detail based on my understanding. And again, companies can get super wonky when they have a huge discrepancy in market cap and enterprise value that sometimes doesn't make a whole lot of sense to me. But I have to do, the analysis with the data I have on hand. And, even if I do a further deep dive and I can't understand this discrepancy, I don't know why historically, it's been this much of a discrepancy, then that'd be something that I just take off my list. There's too many companies out there. I don't need to reach for companies that I really don't understand. There's really no way of me to understand them even after a deep dive. But right now, based on initial analysis, 27% fall before you get to the price we're looking for here. And so this could be something I also do a deeper dive on shortly. But again, sometimes even deep dives, you can't answer every question in that standpoint. I'm not going to be putting any money into something I don't fully understand. And when you have market cap, enterprise value discrepancies as large as this, sometimes there's just some things that I just can't wrap my head around. But I hope you enjoy this video, and I hope you have a very good day. Thank you.